Today's topic is on interest rate caps. I do want this to be an active webinar, so feel free to jump in the chat. I'm gonna try to keep eyes on there. Does anybody have, any of our attendees have any current interest rate caps? Have you purchased one in the past? I kind of want to know who we're dealing with here to kind of target our presentation accordingly. So the Google definition of interest rate caps are, it's a product to limit how high an interest rate can rise on floating rate debt. Let's see, Chad has two. Sarah, a couple new ones. All right. So there's basically two types of debt. You have fixed and floating. Interest rate caps apply to floating rate debt specifically. So we just bought one on a property in Houston that went from 4. Okay. Yeah, that's a Brian's comment right there. Hopefully you bought it at 40K. Interest rate caps prior to the last 12 months have been kind of a formality on loans. It's kind of a check a box. You know, you spend 20K, 50K, 100K. It's about a rate cap that limits your rate exposure on the upside in case things went bad. And since the last 10 or 12 months, rate cap prices have shot through the roof. They're obviously correlated with the rise in interest rates. Most of ours are tied to SOFR. You could have done them with LIBOR previously, but LIBOR's kind of going away. So a lot of lenders are going away from LIBOR. Most of our rate caps historically have been between 50 to 100,000-ish based on deal size, strike rate, all that. We'll get into the specifics in a bit. But in the last 12 months, they have been middle, upper 6 figures and some in the low 7-figure range for rate caps. So that kind of goes over what are rate caps. Let's go through a quick example. Let's say you buy in a $50 million property with a $30 million loan, and the lender says, hey, your rate is SOFR plus 350, 3.5%, right? Let's see what SOFR is as of today. So right now, SOFR, term SOFR is 4.48, call it 4.5. So 4.5 plus 3.5 would be 8%, as crazy as that sounds. But what you could do is buy a SOFR rate cap to limit your SOFR exposure going higher. I don't believe SOFR is going to go a lot higher personally. There's something called a forward curve that people a lot smarter than most of us put together that kind of predicts where rates are going forward. It's never 100% accurate, but it's usually pretty close. So we look at that. If you think rates are going much higher, it's good to buy a cap to kind of limit your exposure. Some lenders require caps. Sometimes you can buy a cap on a floating rate debt and the lender doesn't require it. Or you could have a floating rate debt and no cap and just cross your fingers that rates don't go much higher. There's several different strategies. We'll get into that in a minute. But for that example there, $50 million deal, $30 million loan, if you bought a SOFR cap, let's say 4.5, so you're capping it more or less where it is today. If rates keep rising, your interest cost will be fixed. So that's kind of the concept there. I think they made a lot more sense a year ago when SOFR was 0.05%. That's why rate caps were very, very cheap, because no one predicted that SOFR is going to be 4.43% higher in 12 months. So the inverse of that, like Brian alluded to in the comments, is that the value of his rate cap went from 40,000 to 540,000. You can sell a rate cap as well. So if he sold that property today and the rate cap was valued at 540, at least the companies we deal with, you call them up, cancel the rate cap, and get the money back. So you could have made money on that, and also paid money out, likely paid money out during that hold period as well. So it's kind of a limit if you're trading stocks. Rate cap strategies. You can buy in the money caps, out of the money caps. So historically, our loans were SOFR plus 350 or something like that. So if SOFR was 0.05%, you bought a rate cap of 2%, it wouldn't kick in until rates got above 2%. So a lot of our rate caps initially were SOFR or LIBOR of 2%, 2.5%. So your total rate would be your lender spread plus your rate cap. So if you had a 350 spread, 3.5%, and your rate cap was 2%, your max interest rate during that hold period would be 5.5%. With rates going up as quick as they have, once SOFR was 3.5, a lot of lenders started requiring rate caps of, higher 3.5% rate caps. So basically, if you're buying a rate cap at market, like today's example, if term SOFR is 4.5% and you're buying a 4.5% rate cap, it's usually not that expensive, depending on where the forward curve has it. And right now, the forward curve basically has us going a little bit higher the next few months, maybe the next middle part of this year, and then dropping after that. Whereas 3 or 4 months ago, the forward curve had rates spiking. So a lot of unknowns. There's a lot of variables in rate caps. It's basically you're trading a stock or option, more or less. Some of our rate caps, like I mentioned, were 50 to 100,000 initially, and some of those are valued to $1, $2, $3 million right now. Whereas if we sold the property, we could make a lot of money on that. The inverse is when rates are higher, it drives down prices of properties. So you can't look at rate cap values in a bubble. High rate caps, when rates are high, it usually means it pushes prices down in the market. In the money and out of the money. So if we bought a 4.5% rate cap when SOFR is 4.5%, that's basically even, right? If we bought a 5% rate cap when SOFR is 4.5, we have a little more exposure. We have about 0.5% more interest rate exposure, and we'd be capped at 5%. If we bought a in the money swap, and in the money cap, let's say 3%. So if SOFR right now it's 4.5%, we bought a 3% rate cap, that would pay out every month day one, because we bought it at 3, rates are 4.5. Let's see, Sarah, how does the rate caps value increase over time? So rate caps are valued based on 3 things. The notional, which is the dollar amount. My previous example was $30 million. You have the strike rate, which let's just say we're buying a SOFR 3% cap, and then you have a time value. The time piece is kind of like an option. The closer you get to the expiration, the less valuable it becomes. So if you bought a 3-year 3.5% SOFR cap today, you have 3 years left for that to pay out. If you're 2 months from expiration, the value diminishes because it's only paying out 2 more months. So the real value in these is them paying out. Hopefully rates go higher than your rate cap does and you make money. If rates drop, let's say if we bought a 3.5% SOFR cap for 2 years, right? 2 years, here's 2 years. And rates drop faster than that 2 years, we're losing money. The opposite has been the case recently, where rates have spiked significantly faster than anyone expected. And rate caps that we purchased, let's just say $100,000, 12, 18, 24 months ago, are now paying out. Some of those are paying out over 6 figures every month. So the rate cap providers are losing money, but they're also making money by people buying them today. So it's a lot. Let's take a little breather, see if there's any more questions. I know it was kind of a barrage of information on rate caps. Let's see. We have a question here. I was offered a swap rate for a land deal by a local banker at 6.84% for 7-year ARM. Swaps are different. You can make money or lose money on a swap. So if rates go down, I believe you can lose money on those. I don't like swaps personally. I would either get a fixed rate or a floating rate and buy a cap. My background's community banking. Most banks don't understand rate caps, they do either fixed or floating, or they do swaps. So a swap just takes the risk off of the bank. All right. Pricing and value. How are rate? Here we go. Let's see. All right. Let's see. So they're priced on notional. So notional is a dollar amount. So let's just say $30 million. The strike rate would be SOFR 3.5%, 2%, 4%, whatever it is. You don't want your interest rate to go higher than that. Again, it's that rate plus your spread. And the other would be the time. So 2 years, 3-year term. Let's see, let me go to Q&As here. I was just looking in the chat. There we go. Forced to buy rate cap at extremely high price from Amir. If that's the case. On a couple deals recently, we bought some 3.5% rate caps, and they're not cheap. Like I said, they're upper 7-figure range, upper 6-figure range. A couple in the lower 7-figure range. Are there rate caps percent of loan? Question from Melvin there. So the rate cap would be, in my experience, has been the loan amount. Let's say an underwriter or a lender says you can underwrite the debt to 6%, right? But they think if rates go to 12%, then you couldn't afford it. So the lender in that case would require you to buy a rate cap so they feel comfortable that you're able to make your loan payment. That's kind of the concept, to protect the bank's interest or lender's interest, but it also protects your interest as well. So the rate caps are usually the loan amount. What is the term SOFR? All right, so let me drop a link here. SOFR is SOFR. It's kind of like a LIBOR replacement. Let's see. So this is one website I'll look at rates on. So SOFR, it's kind of an international rate, kind of like a LIBOR replacement. Generally, how long are the terms for the interest rate cap? They usually match the loan terms. So if you have a 2-year loan, a 3-year loan, a 5-year loan, they usually match those. Floating rates don't usually go much longer than that. On multifamily, some of our deals are a 2-1-1-1. So the 2 years being the initial term with 3 1-year options. So in that case, you'd buy a 2-year rate cap closing. And then if you extend to your first option, which will be year 3, you'd buy another rate cap there. So they usually match the loan term. Clay has a question. If interest rates drop after you buy rate cap and your cap is losing money, does that mean you're actually paying your lender, or that the value of your cap is decreased? The second part. So let's say, I'll get back to my example here. You bought a $30 million rate cap at SOFR, let's say 4%, so a little bit, 0.5% below market. And if SOFR drops back to 2%, your rate cap becomes very little value. It's kind of like an option. If you arbitrated options, if you buy an option, in the money, you can make a lot of money. If you buy them, way out of the money and hope it hits it, there's not much value there until it does hit it. So I think options are the closest correlation you can do for pricing rate caps. So you would pay your lender less money. So it's a good thing, I guess. If SOFR your cap was 4% and your spread, let's just say 3%, your lender said SOFR plus 3, you cap SOFR at 4, so that's 7% total. If SOFR drops to 1%, you only pay your lender 4% interest. That's a better deal for you. So let's see, let me go back to the Q&As, the chat. Yeah, worth mentioning, you buy rate caps from third parties. So there's many providers. There's brokers, like anything else. There's somebody looking to make money off of making a connection. There's also reserves. There's a lot of factors here. We're trying to kind of hit it at a high level. Let's see. I believe I addressed what SOFR was. It's a kind of an international rate, kind of a LIBOR replacement, more or less. So we buy a lot of our rate caps from, you can buy them through a lot of brokers. All of ours are through SMBC, the huge international corporation. Another thing to touch on, I didn't have this in my notes. So rate caps, we have one lender that requires the rate cap provider to be graded like A plus. You know how debt is rated. You can have, you know, B, triple B debt, A minus, A plus debt. So that means they require the rate cap provider to be of a certain strength. What they don't want, and that's kind of more like an insurance way to look at it. You don't want a rate cap provider to go bankrupt. Listen, with rates rising, maybe they're paying out a lot of money. If the rate cap provider is not a quality company that has the reserves, it might be a lower grade, and then the lender be put at risk because it wasn't a quality rate cap provider. So we do have one specific lender we work with that requires like grade A plus rate cap provider, and that it costs a little bit more. I would compare that to insurance. You know, a small local insurance company versus like a State Farm or Allstate. So, all right, let me go back here. So, pricing and value. You literally make a phone call. I call SMBC up and I say, we need a $30 million rate cap, a 3-year term, SOFR 2%, right? That'd be well below market. They say, okay, here's pricing. It might cost $1.5 million. So you know, it's paid at closing through your closing, and the term matches up with your closing. The lenders give you dates that match up with the loan payment dates. So there's a reset date and a payment date, and there's a set date. So like on the 9th of every month, they take an average of SOFR for the last 8 or 10 days, and that's your rate, and they determine if it's paying out or not paying out based on that. And they usually try to pay out, match up with your lender's payment dates. So if your interest rate payment to your lender, you're still billed at the full rate. So back to the example, if you buy a rate cap of 3% SOFR and the lender is charging SOFR plus 350, it'd be at your lender would still bill at about 8% range. So you're making the 6.5% interest rate payment yourself, and then the rate cap is providing the additional 1.5% of the interest payment due to the lender. So when are caps needed? This is a big one. So most bridge lenders on floating rate require rate caps, but they only require rate caps for the initial period, be it 2 years, 3 years, some go 4 or 5. But if you're doing an agency deal, Fannie or Freddie, they require a rate cap on floating rate, but they'll also make you escrow for the rate cap renewal. That part's like tax or insurance escrows. So every 6 months, they reprice the rate cap and they adjust their escrows. So let's just say you're doing a 3-year deal with Fannie Mae. At closing, the rate cap's $1 million, right? 6 months from now, if rates go down, they reprice it. Oh, that rate cap is now $600,000. So they would adjust your escrows down since you don't need to escrow as much. If 6 months down the road from then, so a year out, rates dropped more, and that rate cap is now $300,000, they would continue to adjust your escrows so that at the time of renewal, the initial period, you'd have adequate funds to purchase the rate cap. So let's see. Any other questions? Go to Q&A. So for a new multifamily investor who is buying their first multifamily, what kind of interest rate will they get in today's market condition? That's a very broad question. That depends if you go in a bridge lender, you know, 2 or 3 year lender. If you go on an agency, most agencies are the corresponding treasury rate plus the spread. Let's just say 5, 7, or 10-year treasury rate plus about 2%. Those treasuries are about 3.5 or so. So you're looking at 5.5, 6% rate ballpark for a good deal. And if you have a smaller deal, a smaller market, that's could be higher. For a bridge deal, you're looking probably about 6%, 6 to 6.5 to 7, depends on the deal. I can't answer a whole lot better than that without any more specifics. Dave has a question. Any chance that these interest rate cap providers could get in financial trouble? So that kind of goes to the rating. How can you tell if they have the potential to go belly up? I think it got cut off there. That's all I see. That goes to the rating. So that's why we use SMBC. They're the biggest. I believe they're the biggest. SMBC stands for something like Samsung, something. It's like 3 or 4 international major corporations that this is probably like a small percentage of their companies. So. And another comment here, we're looking for limited partners or GP. We'd like to raise capital in our JV. How can we connect with groups or investors? That's a good question. Again, not really relevant to today's talk, but just continue to network, I guess, and find like-minded folks that are interested in the same deal you are. That's my comment there. So I'll drop a link to SMBC in here. It stands for Sumitomo Mitsu Banking Corporation. I think Sumitomo makes tires, and then Mitsubishi, I don't know, it's a big company. So Moodys Rating is the rating I was referencing there. So you can Google SMBC for more information. And that's one. Again, there's brokers as well that broker rate caps. Like anybody else, looking to make money off of doing something you can do yourself. So there's a lot of forms. Once let's say you have a lender, you have a deal, then they say, here's the rate cap. Rate caps take a couple days to a week to get onboarded with them. There's several forms you have to get. We have to get Bloomberg LEI numbers for certain deals. You have to go on the Bloomberg site and it's kind of like an EIN number for your entity. You have to have your articles of organization, a lot of docs. It takes time. So make sure you're getting ahead of that time-wise. You don't want to wait till the day before or the day of closing to try to do this. You can call any rate cap provider today, start getting prices. You can buy rate caps day of closing, day before closing. You can buy them a week before closing. You can buy a rate cap a year out if you want to. Let's say you have a deal that expires, your initial term expires November 1st, 2023. You want to buy an additional 1-year rate cap. If you think rates are going to keep going up, you can buy that rate cap today. You can buy it, the day before the extension. There's a lot of strategies here. I only touched on a couple of them due to time constraints, but Celine, is it worth it to get a rate cap on a small deal, 20 units? I'd probably say not. That kind of goes towards risk. I mean, the smallest rate cap we've purchased is on probably $5 or $10 million loan. If you're borrowing any less than that and you're getting a floating rate deal, I would just save a few bucks every month in case rates go higher. And like I said, in my opinion, I don't think rates can go a whole lot higher. The Pinsford site that I mentioned previously has a forward curve. So you're welcome to look at their forward curve. I would compare several folks' forward curves just to match them all up to see what you think. And forward curves change on a daily basis based on markets. So right now they have term SOFR kind of peaking from March, April of this year at about 4.8 or so, 4.9, down to September, October. So kind of going 4.8 or so, then have it dropping, back down to high 3s and then 3% as of August 24. So that changes daily. And it's kind of the speed or at which it increases, decreases that I look for, and the height of the rates. So previously this year, they had it kind of raising quicker, and now they kind of have it as rates are already higher, they have it kind of leveling off and kind of tapering back down. So if I didn't have to buy rate cap in this market, I probably wouldn't, but I would make sure I have adequate reserves to ride the next 50 basis points of rate hike up. I think that answers Celine's question there. Let me go back to Q&A. All right, any more questions on rate caps? Again, we kind of try to hit them at a high level. But like anything, I would shop around, reach out to a couple of different rate cap providers, talk with your lender about rate cap requirements. Another strategy on rate caps is called a stepped rate cap. So if you have a property that's it's in the stabilization phase, let's say you're continuing to lease up and you think you're gonna make more money, more cash flow from the property in years 2, 3, 4, you can do what's called a stepped rate cap. And they're cheaper, much cheaper. So if you're buying a 3% rate cap today on $30 million, let's just say that's $1 million rate cap, right? If you bought a stepped rate cap, so year 1 would be 2%, year 2, 3%, year 3, 4%. So it's going to be higher over time. That would cost you, maybe half as much, right? The lender, the rate cap provider, doesn't have the exposure to a fixed rate over time, but they'd have pay out less over time. Assuming your property would make more money over time, you could kind of cover the additional cash flow needed. We had one of those stepped rate cap previously. I don't like them, generally speaking, but if you have a lease up property and you can't afford the full value of a rate cap day 1, that could be a way to reduce your upfront cost. Another thing, you can cancel the rate cap, at least with our provider. Call them up and cancel it and get your money back. So if you sold the property today, call them up and they'd send you the value of the rate cap today, possibly some fees there. So I hope that answered a lot of questions. I know it's kind of a brief conversation, but I'm gonna give it a second and chat and Q&A and see if anybody else has any more questions or any more comments about rate caps or anything else I can help with. So. All right. Well, I appreciate everyone joining us today. If you want to take a minute to check out mfincon.com and we can meet our team in person in Charlotte. Here's some incredible guest speakers, network with some folks, learn more about multifamily investing and find your next deal, maybe find a lender, maybe find some GPs, LPs, whatnot. Let's see. Sarah has a question here. What would the benefits be of having a rate cap if I was doing a presentation for a money partner? It would limit your exposure. So kind of to answer both of your questions there. Let's take it back a year ago to February of 2022 when SOFR was 0.05%. Let's say a lender says the spread is 3.5% plus SOFR. So that starting rate would have been 3.55%. Nobody that I knew of knew SOFR would go up, 4.5% in 12 months. If you didn't have that rate cap in place or significant reserves, I mean, your property, you couldn't pay the debt. So the risk to an investor or money partner would be limiting your exposure if rates go higher. And the risk if you don't purchase one, you can't pay your debt, and that's not good. So a rate cap's common in other asset classes besides multifamily. Predominantly multifamily. We have them on a couple storage deals. You can buy them. I mean, the rate cap provider doesn't care what your loan's for. You can just call it buy one if you want to, blow some money. So they're not. Another thing I want to touch on. Sorry, some lenders require the rate cap to be pledged to them. That means payable to them, and then they process the payment. Some lenders don't care. I like it when the rate cap goes to our operating account so we can kind of see, let's say, that $1 million, that $100,000 that paid out this month, and account for it all on one checking account there. So no, you can buy rate caps on any loan. any floating rate loan to kind of limit your exposure. We did have an issue recently where the rate cap was above. They didn't want to sell the rate cap above X value. It's too big. So we had to look at some strategies there. One of the last thing I'll touch on before we end. You can buy a rate cap much below market. It's like I said, right now SOFR is 4.5%. On a recent deal, we bought a rate cap of SOFR 2%. So that's paying out day one. The lender spread there is 3.5 to 375 or so. I think it's so our starting rate and our fixed rate, quote unquote fixed rate, would be 5.75% for the term, the initial term. When any of the lenders can get you be closer to 7 to 8%. So that was an expensive rate cap, but it's paying out X dollars per month for 24, 36 months. We think it's a smart investment, and makes sense for us, and it limits our upside as well. So, well, I appreciate everyone joining us, and I hope to meet some of you. Hold on, I got one more question here. Let's see. Xavier's question. Looking at a deal in St. Louis and Cincinnati, Ohio. Wonder if it's easy to find buyers in the multifamily space versus residential. The multifamily is definitely a small fraction of residential, but it's a more educated financial buyer. You're going to market your deal nationally. You're going to have investors from all the country. You're going to have national lenders. It's a much more run like a business opposed to residential deals. So I hope that the deal works out for you. Well, thank you everyone for joining us. I hope to meet you in Charlotte in June, if not before. See you.